What's going on, my friends? Happy Friday. Is it Friday? 4 o'clock Pacific time. I'd like to thank Goldman Sachs for the alley-oop today. We're going to have some fun. Let's do this. Maybe down a little bit. Bring my homie in. I got a special guest joining us today. Ryan Street is in the house. What's up, brother?
Not too much, man.
All right. Real estate professional, Valhalla team. And you brought some things to my attention here recently. You sent me this article. You got some things to say. I always got things to say. So we're going to get her done today. Now, this one, what's interesting about this, there's a lot of things. Let's be real. A lot of things that are very interesting about this article. But it's obviously extremely bold. So I wanted to just share it with people. It's been going around. I've seen as soon as you made it, you put it on my radar, I started looking around and people were sharing it all over the place. People were asking me about it. Like, is this real? Like, Goldman Sachs has credibility. They're kind of a big player on the Wall Street scene. Why are they saying? Because, by the way, one of the 4 U.S. cities that will suffer a 2008 style crash, according to them, is San Diego. That's one of the cities. So always with these things, we got to break them down top to bottom. Headline first. Bold headline. Very bold headline. Are bold headlines usually followed through with in the article?
No.
Not so much.
No.
Not so much. So here's what it says. 4 U.S. cities could see housing prices reach 2008 levels. I can tell you this. If there is 4 cities, San Diego won't be one of them. But I saw this just recently. I don't know if you caught this or not, Ryan. Ara Abnanian, who is the CEO of one of the top 6 biggest builders in the country. He said that the housing market is normalizing.
Right.
So they're right there immediately underneath the headline. The first thing is a link to a guy who owns a huge home builder saying that the market's normalizing. Meanwhile, we're going to feed you this stuff about how markets are going to crash. So we're going to share with you a bunch of information today. We're going to look at mortgage rates, history. When was the bottom? Is the bottom behind us? Is it in front of us? Like Goldman Sachs says, we're going to look at price per square foot. We're going to look at the market action index on Altos. We're going to look at mortgage rates, everything. We're going to get to all this stuff today because this is a good bell ring. When an article like this comes out, it's like, hey, maybe we are too close to it. Maybe we haven't researched enough. Maybe we need to go back to the charts and take a look at the data and then see if maybe we were wrong. So we're going to do that today. We're going to do it live right here. We're live on Facebook, LinkedIn, for goodness sakes. We're live on YouTube, Twitter, all the things. So comment, ask a question if you want to. I'm kicking it here with you guys for a little bit. So ready, Ryan? Here's what it says.
I'm ready, baby.
Goldman Sachs expects home values to worsen through 2023 amid continued skyrocketing interest rates. Interesting. I'll show you the chart on that. You tell me if they're skyrocketing or declining. And declining housing prices. We'll also look at that chart and see if you think housing prices are going up or going down right now. They said San Diego, there it is, San Diego, San Jose, Austin, Phoenix. We'll likely see, here's what they said, notable increases before drastic decreases of more than 25%. So not only are they calling, Street, for prices to go down, they're actually saying they're going to go up first and then go down. In my experience, it's difficult to call whether a market's going to just go up or down, much less to say that it's going to go up and then it's going to go down. Seems a little far-fetched to me, my friend.
There's so much going on there. As you mentioned on the intro, I think they're capitalizing. Well, let's be honest. Fear mongering has absolutely been the number one tool of the mainstream media the last however long time.
Forever, decades.
Right. Walter Cronkite is spinning in his grave as we speak. And they're capitalizing on folks just knee-jerk reacting to just a headline instead of actually reading the entirety of the article. Or
doing their own research.
or even that, it's like, oh, here's a tagline, and then we go running through the office and like, oh God, what are you gonna do? That I got this this article forwarded to me from, I think it was 11 different people in 48 hours, starting Wednesday night, I think, and read it and then watched Ara's video. There's so much contradiction in this entire piece. It's like, it's nothing but confusion, and I think that might be the idea. Maybe shake the tree, because we'll get into inventory here, shortly. We got the largest asset manager on the planet, who's got, the last I heard, I think it was 120 billion they're waiting to deploy in single-family detached homes.
Mm-hmm.
And they're good friends over at Goldman Sachs, as you discussed on the intro. They have credibility. Hey, buddy, why don't you give me a hand here and see if we can't get some panic listers to throw their houses on the market, because the correction wasn't as deep as we were anticipating coming out of the high inflation.
That's true. A lot of people had capital. There were people raising money. Even Meet Kevin started his own fund, thinking real estate was going to crash and he was going to buy it all up. And a lot of people thought that, and we didn't really get much of that. And I'll actually show you exactly what that looks like. I just want to flush this whole article out because, as you said, it's very contradictory. But unfortunately, people don't read more than the headlines.
God, right.
So what people did here, I can tell you right now, they stopped right here. They just looked at what 4 cities is it?
Yep.
And that's it. You don't go any further than that. You go in here, you got to kind of look at, okay, well, what did they say? What is the reason? Okay, well, they're saying that they expect rates to actually, stay a little bit higher, to go a little bit higher than they are right now by the end of the year, essentially meaning that rates would stay flat. They're also saying here, I'll quote this: there's a national decline in real estate that they expect for 2023, but it should be small enough as to avoid broad mortgage credit stress, with a sharp increase in foreclosures nationwide seeming unlikely. So sharp increase in foreclosures seem unlikely, yet people are just going to naturally sell their homes at a massive discount in these key cities. That said, overheated housing markets in the Southwest Pacific Coast, such as San Jose, Austin, Phoenix, San Diego, will likely grapple with peak to trough declines of over 25%.
That's very key right there, Derrick. That is so key, because how far have we already come down?
Yeah, well, let's start taking a look at some of this, because I do encourage everyone. I'll put this link in the YouTube description so you can read it if you want to. But I mean, when you look at what's going on here and the stuff that's super interesting about this, almost every single thing that's said in here is completely contradicted by common sense. So let's look at this. First of all, here's mortgage rates. Okay. And this is from the Federal Reserve, right? So they give us a history of mortgage rates, goes back to the 70s. Well, let's just pull it up to, let's say, the last few years. Okay. Here we go. Now, rates have obviously, gone up, but look at what has happened since October, where we hit 7%. Do you see are rates going up or rates going down right now? I mean, rates are going down. Rates have been going down. So to say that rates would continue to stay high, when we have already seen, the Fed pivot, we've already seen that the economy is strong. We got the inflation number today was better than expected. We're seeing things improve. Why would rates stay higher? That's an interesting call. You would need to tell me some other reason. There needs to be some reason. What's the reason? Well, the stock market. We think the stock market's going to crash, or something, or we think the stock market's going to. We think the stock market's going to go way higher, and so we think people are going to stay away from bonds. They're going to sell bonds, and therefore there's going to be sell pressure in bonds. There's got to be some reason if you think that rates are going to stay high, other than all the things that are obvious and out on the table. So that's one thing. And here's what you were asking for, Ryan. I'll give you this. So this is also from the Federal Reserve, and this is housing prices. And they give you this per quarter, so you kind of have to zoom out on it a little bit. So this is per quarter, average national housing price. All right, and you can see we had a big run. This little gray area right here is COVID, and we had a big run after COVID. I think everybody knows that. But look at this. So that's Q3. We peak in Q3. Q4, we drop from 547 to 535. 547 to 535. It's a 2% drop. Now that's including Q4. Now in Q4, we had the highest interest rate between Q3 and Q4. We had the highest interest rates we've seen in years and years and years, right? We have the highest interest rates. 2% is what the value of homes dropped nationwide. 2%. So you're right, my friend. That is not what BlackRock was hoping for. That is not what Goldman Sachs is hoping for. That is not what Wall Street home buyers who want to buy all the homes in this country were hoping for. They expected people to panic. They expected 2008 again. They did not get it. Just that simple. They didn't get it.
And it isn't coming in 23. Barring anything, given the current market conditions and the information we have available now, obviously you've got the issue in the war in Ukraine, or however that goes. It just also didn't really impact anything. And yeah, here's the visual I sent over.
Yes.
Inventory. That's if you look on the left, these are detached residential homes that are on the market for standard sales. There's 1,023 homes in San Diego County that are currently available that are not under contract.
So here's the numbers over here, right? Here's the graph. Here's the timeline on the bottom. And look at the move here. So we had a little, people call this spike in inventory. This is what, if we were going to see a crash, we would need to see this moving very violently. We would need this to really move higher.
Yeah. Into the low five figures.
Yeah, we would need it to be way, way higher than it is now. And it would need to be sharp. So you'd have to have a lot of inventory come on, at the relatively the same time, so that then sellers would be in situations where they're fighting for buyers. And in order to get that buyer to buy our house, we have to drop our price to here. And that's how a crash happens, is you have more sellers than buyers. Look what's happening. The exact opposite is what's happening. Look at inventory falling off a cliff. I mean, just disappearing. And this is just inventory. This doesn't reflect home prices. We know home prices have come down for sure. Not a crazy amount, but they have come down from the peak. No doubt about it.
And Derrick, I'd even like to highlight within this inventory what's really going on out there. There's a number that's hidden here that unless you're out in the street showing property, week in and week out like I am, of the 1,000 homes that's out there that are currently active and available, 4 out of 5 are almost absolute trash. And then there's one, the remaining 1 out of 5 is a unicorn that's going to sell in 10 days because it's been taken care of. It's been updated. The remaining 4 that are, haven't been taken care of or haven't been updated are sellers that missed the boat, from a year ago or a year and a half ago, whatever. And now they want to get peak of the market prices, and they're just entirely unreasonable. And that's skewing the data in terms of days on the market, So there's so much hidden. Even we have these fancy tools and all these graphics and stuff we can show. There's still, so much information that's tucked away in there that unless you're out there looking at it all the time or frequently, you just don't know. I showed last weekend. I took a client out on Saturday. We had 11 homes that they liked from my search site. I knocked it down to 5 just based on location, condition, price. And then we further knocked it down or got rid of another one because the price was just ridiculous. Like the comps around it were 50,000 lower that had sold recently. And this one been on the market 177 days, and we had one that we liked, 1 out of 5. And unfortunately somebody snatched it out from under us. It was our first day out, so
it sounds like a first day in this market,
right? It's like, but
well, I mean, here's the thing, and the reason why I wanted to do this, make this content, make this video with you, is because you're one of the people who I know when things were crazy, when the frenzy was in, you were kind of telling people to pump the brakes and to sit back for a second and take a breath, and if you didn't have to buy right away, maybe sit for a second. I didn't hear a lot of people saying that, especially in the throes of the madness where it seemed like we were just going to go to infinity.
Yeah, we saw, the run or the frenzy, as I call it. We have a fiduciary responsibility as agents, not to get into the weeds of legalities or what's, especially on my side of the fence. You got to ask those qualifying questions. And if it's really not in your client's best interest, you throw out there, hey, let's, hey, if you're already in a lease that doesn't expire till, June of 23, let's kind of wait it out, because the last thing I want to do is put you in a home that's going to be worth 50, 60, or let's say 100,000 less in a year and a half. Should these interest rates, given the information we had at the time, Wells Fargo was putting out, hey, spring of 23, we might be breaching 8%. We touched 7 in October. To your point, there was some white knuckling going on there, I would imagine, for a handful of folks that that locked in their rates at when they did. But anybody that was still trying to shop, and we have a mutual client that we were working with, and we were out there hustling, trying to get out in front of it, and it just didn't work out. We'll get them taken care of here as soon as it's in their best interest to do so. But as a real estate agent, a realtor, broker, whatever, it's like, and we did have an influx on both sides of the fence, mine and yours, of licensees, as I call them, that weren't necessarily doing things the way that they probably should have been done. There's more to real estate than selling a couple of homes a quarter, running down to Cabo and taking fish face selfies, and posting them on Instagram. There's you got to know this kind of stuff. You have a true professional, and ultimately we're the ones that are going to make it through this tightening on business, and we're going to come out of it just fine. But I guess my point is, it's I almost welcome this slowdown, because it kind of gets rid of the some of the fringe that's not doing this for the right reasons.
Yeah, for sure. It definitely clears out a lot of part-timers, if you will, and so forth. But I will say, this. So if we look at this peak in inventory here, and I don't have exact date for this, but it looks like it's about in the middle of 22 is where the inventory peaked. And look at that peak for there. 2,000 is not a lot. I mean, it would need to be double, triple that to really be like, wow, there's homes everywhere. Because that people just don't understand. Like, people aren't just going to sell their homes for less because. They're going to do it because they have to, and they're only going to have to if there's a whole bunch of people all selling at the same time. That was the problem that we had in 2008. The banks didn't really know what they were doing. They foreclosed on everyone. People couldn't pay for their homes. They were getting crazy loans. So everyone went to sell pretty much the same time. That's what caused the crash. That's the reason why I've been saying that that's never going to happen again, because the banks are never going to handle things that way ever again. And people are more wise to it. They're more wise to the fact that if we do see a housing crash, that you should buy. You shouldn't sell. You should hold. If you own, you should hold. And if you don't own, you should buy. And that is much more widely known now than it was in the 2008 crash. So all those things kind of add up. But if we just look, we're just looking at numbers today. We just want to kind of show you, like, this is what's going on. Okay, so let's keep this in mind here, because we look at this inventory figure that we have right now. Really, we're not far away from being at the lowest levels since like COVID.
Right.
We're really close to that. And we all know what happened when that happened. Now, we had lower rates then. We did. So I'm not saying we're going to go, straight to the moon, but that's the inventory situation that we're in. And that's a very, very, very important piece of this puzzle. So let's look here at this too. So remember, okay, so mid 2022. Here's also another inventory graph from Altos Research, which just kind of shows you the moving average of inventory. And you can see it's really, really dropping fast. So what does that mean? If we're seeing inventory drop, that means that sellers are not wanting to sell. And when sellers don't want to sell, what does that mean? That means they believe that it's worth more than what the market currently is at, right? If sellers are reluctant to sell, they're not willing to take the bid, then they're simply just not going to put an ask. An ask is when you put a listing. They're saying, okay, I'm asking, $800,000 for this house. There's no ask. Okay, they're not putting the ask out there because they're like, I don't like where the market's at. Now the market goes up more, then you see more people being willing to sell. But then also people decide that they want to hang on to it because they see that it's going up. So you see how that works? Now that people know that a crash is possible and know what it looks like when we do crash and that we do recover, it's less likely for people to panic sell. But you can see the inventory dropping off hard, which just means that sellers are not into it. This is what I want to do. Now, I haven't looked at this yet, Ryan. I'm gonna look at this with you right now. So market action index, this is the action in the market. Altos Research provides this number. They do it in their report for each area, each zip code, each city. and you can see it basically measures, hey, is it a buyer's market or a seller's market? Like if I go up here right now, we're at 46 out of 100, which is actually technically a seller's market. It needs to be below 30 in order for it to be a technical buyer's market, which it was for a very, very short period of time, I believe. So let's go over here and let's look. We actually got down, the 7-day average got down to 29.91, and that was in November. So if we go over to the middle of the year right here, that seems to have been the absolute best time to pull the trigger, right around, July, early July, early to mid July, or really the month of July, what seems to be the perfect time where we had buyer's market conditions. That was before rates peaked. Rates peaked in October. So July was really the perfect time based on this. Now let's look at the price per square foot as well. This is my favorite measure. This encompasses so many things all in one, and that's why I like it. It really shows you what people are willing to pay for a square foot of real estate in San Diego, right? A finished square foot of real estate.
Yeah, right.
So here's what it looks like. Now, for this whole bull run, we saw that the 7-day average, which is the dotted line, would come down to the 90, and then it would come off of that. It would bounce higher off of that. Now we're kind of seeing the opposite, right? It's coming up and it's touching it from the underneath side, showing that, hey, the market is heading lower. But it's right in the process right now. Look at this. The 7-day average is crossing the 90. It's crossing it over. So if the 7-day average gets back above that 90-day average and starts to bounce again, that could mean the next leg higher right there. If we just look historically at what this has done, what's happened here, that would tell us. Let's see what we were trying to do. We're trying to look at peak. Price per square foot peaked.
It was 707.
Right in there, yeah, right around
710.
And that's at mid-May. So mid-May is when price per square foot peaked. And then if we go over here to July, right in July, mid-August, you saw a big dip in price per square foot that has sort of continued to decline, but is now just starting to round off and head higher. So if we just look at price per square foot, this is my favorite piece of data. Like if there's one piece of data you follow, if you want to follow a real estate market, whether it's San Diego or wherever it is that you are.
Derrick, what's that? What's the date on the left and the bottom? I can't see it.
Down here. Oh yeah, it's my bad.
January 20. Okay. So
this goes back 3 years.
Gotcha. All right. So we'd be right.
3-year graph.
Doesn't really correlate. Okay, cool.
Yeah. So you can kind of see there. That's a little bit better. I can't fit it in there with.
It's better that the viewers see it than I do. I just was curious.
No, yeah, you're right. Thanks for that. I'm a one-man band here.
That's right. That harmonica on that neck stand, baby.
Okay, so we looked at housing prices here. I can tell you from a mortgage-backed security standpoint. So what actually dictates mortgage rates? I mean, just look at this. Look at the action here. It's almost just nothing but green candles and the slow, steady increase, which is what we've been predicting here on this channel, that we were going to see rates just slowly decline. And bond buyers are coming back. Goldman Sachs is unwinding their bond short. Okay, I don't know if you saw this or not, Ryan, but Goldman reported a horrible quarter, a huge miss.
Imagine setting themselves up for another one, huh?
Well, what they did was they crushed 2 quarters in a row, and each time afterwards they said it was our bond desk, our trading desk, and our bond trades that really made the difference for us. Well, bonds were getting murdered at that time, so obviously Goldman was shorting bonds.
Sure.
They have to unwind that at some point, and I think the expectation is that now is the time. Now, could be part of the reason that they put this article out there. Could also have to do with their bond investment. That could be one of the reasons, because they still have bonds to buy back, and they don't want to have to buy them at crazy high prices. That could be one of the reasons. Mm-hmm. I'm not quite sure, but I can tell you this: the price action looks very, very, very good here from a perspective of just technical analysis, looking at the 5.5% coupon, we're in really, really, really good position here to see this go higher. I wonder if I could do it like this. Yeah, there we go. You see this go higher. You see the moving average here. We got our support and resistance. Everything looks very, very good here. I do expect we're going to continue to see this type of action all year long. I do expect to see rates in the 4s by the end of the year, especially for FHA and VA. Conventional rates may hang out in the 5s or the low 5s or something. That would be huge. Right now, here's a quick snapshot. My rates are about 0.25% less than this or so, but this gives you a good general, look at, okay, hey, here's, 30-year conventional, about 6.25. The arms just don't make sense at this point in time. No. And then, FHA and VA are really closer to 5.5. This is really closer to 6% in my world, but this gives you a decent idea and understanding of, hey, this is what these things are on average. And so this is not bad. This isn't terrible, but notice this. We go over to home prices. Home prices peaked in Q3. Q3 is also when interest rates peaked, right? Interest rates peaked up here in late October. So I guess that's Q4, right? Q3, yeah, October, yeah. So that's Q4. So they peaked in Q4, and that's where we saw this sort of tiny decline. Now, the next quarter worth, this could go down again in the next quarter. But I believe by the following quarter's results, when we actually have Q2 of this year on here, we're going to see an increase. And so you'll see this little dip, and then you'll see a little pop. That's my prediction. That's my guess. Anything could happen, of course, in financial markets. This isn't financial advice, but that's what I believe is going to happen. And based on what we're seeing in the marketplace right now, I mean, what you just described, Ryan, when you were talking about working with, a buyer, your first time out, hey, here we go. We're gearing up. We're going out. This is what to expect. What I'm seeing right now is multiple offer situations. Buyers not getting the home that they want because they're not willing to go up as high as the next person is. Right. Buyers aren't really conditioned to be back into this market again already. Agreed. And so a lot of them don't want a bidding war, but that's what you've got. If you're getting a great house, that's what you've got.
You've got a combination of, you've got some of the holdovers from last year, that just backed off, like, okay, 7%, 6 and 3, 6 and 7, 8. We're just not doing it. So we're going to ride out till the holidays, and then, we get some of this early sellers that have to sell, whether it's a trust thing or a passing or a divorce, whatever. You got these holdovers from last year that are cagey veterans in terms of the negotiation piece, and you got the new guy, Johnny come lately, that's just getting into absolutely why the one house that we were going to write on was gone. It was a multiple. They were already in the seller multiple had already gone out, and these folks liked the home. They didn't love it. They kind of tipped their card or their hand to me, and they're like, hey, what do you think it would take to get this? I'm like, look, first day out, we're still in a position where I think we can do better. I know it's heartbreaking, when you lose the first one but hey, if anything proves itself time and time again, as cliche as what I'm about to say is, it proves over and over again, it's always darkest before dawn. You know what I mean? Mm-hmm. Just when it looks like it's going sideways, or you're not going to get it, something changes, the house falls out, or something, or for whatever reason, or whatever circumstance, it's folks always kind of seem to land where they're supposed to be.
That's right.
Passing on the rushing into something. It's typically, in my experience, not in the client's best interest.
Yeah, 100%. Take your time. I mean, you have to figure out what the market is. That's why I always encourage people, go look at homes, smell homes, touch homes, see what's there, see how much people are asking. Favorite homes on Redfin, watch what happens, get the notifications. Oh, it sold for, how much did it sell for? How quickly did it sell? Get a feel for the market, because I feel like if you look at enough homes and you pay attention to what's going on, then when you see the right one, you'll know it. And that's when it comes to, okay, hey, we want this house. This is our house. What do we need to do now? And then that's where your professional comes in to help you not overpay, but ultimately get the house for as little as possible. And we, a lot of times when people are shopping, unfortunately, I don't know why this happens, Ryan. I have no idea. But a lot of times the first one they like is really the one, and it's the same thing with sellers. It's like that first offer you get a lot of times, that's your best offer. And so it's weird because I encourage people to search and to look and to study. But a lot of times you end up comparing all the other houses to that first one. Man, we should have got that first. Man, we should have wrote on that first one. Man, we should have done this. And that becomes difficult. So you can get in your own head about it. But now there's not really, here, let me pull it back up. This, where is it? That's the inventory situation we're in. Look at this absolute cliff dive. That's rough, guys. We are in a very, very problematic inventory scenario right now, where there just isn't that much to choose from, and we have a tremendous amount of pent-up demand. People have circled back now a year later, who decided to get into a 12-month lease early last year because they were sick of bidding wars, and they're going right back into them. That's how much the market, has reacted. People want to buy real estate in San Diego. So for Goldman Sachs to be able to, can I come back to that?
Yeah, please do. Please do. There's so much. We should do another video on the bottom half of this article.
I am not done with you yet. I do appreciate the layups, though. I really do.
Oh,
Thank you. Thank you very much. Because I can't believe they call it San Diego. Of all the places, that's right? Completely bananas. Completely bananas. Boise, Idaho's not on there. What about some of these second home cities? Tahoe's not on there.
Nashville.
Yeah, to see a 25% decline in Nashville wouldn't even be that much.
Denver.
There's a bunch of them. Yeah, Colorado's got several of those kinds of markets that are like second home markets. Why wouldn't you say those are the ones? Wouldn't the high second home markets, the big bears and stuff, wouldn't they be the first ones to get swiped if there was a really big swipe?
Well, if you had an ulterior motive for releasing something like this, and you were trying to shake the tree of the locale that you were most interested in, I guess I'd probably, if I was not an honest man, I guess I'd do something like this.
Well, that's an interesting point you make, because if you look at these four markets that they're talking about here: San Jose, San Diego, Austin, and Phoenix. I know Austin and Phoenix for sure were big markets for the BlackRock investor, Wall Street investors. I know that they were buying stuff a lot in those areas, and I know that they want to own a lot in those areas. We didn't see as much of that in San Diego. There's a lot of multifamily, but not a lot of single family stuff. And there just aren't enough homes for sale, plain and simple. It's just not there. I don't know the San Jose market that well.
I don't either.
But what I've seen of it is absolutely bananas. It's San Francisco plus one or two. It is wild how expensive stuff is up there, but also the concentration of money in this area is off the charts. Off the charts. Everybody's got a $2 or $3 million house. Everybody. It's crazy. So why would those folks capitulate? That also doesn't make sense to me. I really don't understand where any of this is coming from. None of it makes any sense. So what's the ulterior motive? What is the reason? Well, a couple things that you can accomplish just with this headline. And this is what I think everyone needs to understand from a journalistic perspective. Like, even when I was going to college and in, a journalism school, the people who write the headlines and the people who write the articles are not the same people. And in fact, when you get to big enough media, they don't even have the same bosses. This clearly, to me, look at how it's labeled. Now, they don't tell you, I believe, on here, at least I didn't see that this is a sponsored article anywhere, but it obviously is. Look at the branding. Guys, if you pay for an article to be written, it's going to look like this is what it looks like. We call it advertorial, right? So there's editorial, which means a journalist wrote something based on an opinion, based on data, based on research. Then there's advertorial, which means that it's actually an advertisement, and it's written by the advertiser, and the editor obviously has some control over what is said and how it is formatted and the length and all those things. But I didn't see anywhere on here. Usually it'll say like sponsored ad or something. Maybe it's way down here. I don't know. I didn't see it anywhere on there. But this is the closest thing we've got to it, is right here. It says Goldman Sachs published here. Goldman Sachs. Why does it say Goldman Sachs published?
Right.
What's this about? Like, I don't quite get that. Maybe we're supposed to click here and figure something out. No, that just takes you to a search page. So, I don't know why it would say that when that's the first word in the article anyway. But needless to say, you have a headline that's stating something really, really big. It gets the point across. So people tend to just read the headlines. I know this is terrible, but for the most part, people will just scroll headlines for the most part. Now, this is one is curious enough. I think people might click and actually see which 4 cities they're talking about. But probably that's the end. Probably that's as far as they're going to go. Maybe they'll watch the video. Maybe. If they do, they'll hear a lot of contradictions to what this article is predicting. I can tell you this right now with great certainty. There is no way, and I mean no way, that San Diego housing goes down 25% this year. It's not one of the possibilities out there, unless the whole world goes to hell. That's really the only way that would happen. But from just a market standpoint right now, Ryan, investors are pretty much in their pocket. They don't know what's going on. Remember, investors, when we talk about flippers, they have to buy, and for a quick sell, they need to sell within 60 days tops, right? Or 90 days tops. So they need a quick sale, and they are being very conservative right now. Normally, those are the guys who would be scooping property up at a discount. They have been somewhat sidelined. As the market normalizes and they can start to see things pencil, those buyers also come back. They're not really here right now. They're not buying a lot right now.
Right. Yeah.
So
it goes into the one of the aspects hidden within that kind of skewed inventory level that it could be like, to your point, it's already like apocalyptic as far as inventory. It could get really bad, especially with what was it, 2.5 years of rates in the low 3s, low 2s if you were VA, or high 2s if FHA. People are going to sit. Why make a change when you're going to cash out on your and you're going to make 30% or better on your home that you've been in since 2018 or 2019, and then roll it over only to have your new home your new mortgage payment eclipse your old one, whether you're stepping up or stepping down, after you've applied all of your equity, and your new payment's going to be 40%. Maybe that's a little hefty. 25% higher.
Yeah, or more, man.
Right.
Think about it, because prices are up and rates are up. So you got the double whammo for the sell buyers, and an awesome point to make too. We were talking about sellers, why they aren't selling. Well, they obviously don't want to sell for this price, but another reason is a lot of sellers are buyers, as Ryan's saying. And so if you're a seller and a buyer, you're looking at, okay, well, here's the 2 rules of thumb, right? You move up in a down market, you move down in an up market. Well, either way, it doesn't matter which way you're going right now.
Nope.
You're going to have a higher rate than you do on your current home. There's no doubt about it. And you're probably going to pay a higher price than you paid for the home that you own, or the market's higher. So if you're trying to move up, you're going to end up paying way more, than what you're paying on your current place. And I've had a lot of buyers actually get to that point where they, hey, I'm going to see what we're pre-approved for. I want to see what stuff looks like, and look at the payments, think like, I just can't swallow it. It's $3,000 a month more than what we pay right now. We're just going to figure it out. We're going to see if we can build an ADU and figure it out here. I've had a lot of people say that. And so that's also hesitance. A big reason for this hesitance for sellers is that they can't find it making sense on the other side. In the run up, we had sellers who were like, well, hey, we're going to get a lower rate. We refinanced or whatever on the house that we have, but we're going to get a really low rate on this purchase. So it sort of makes sense to us. We're paying 3.25. We're going to get 2.75 on the new loan. Okay, it's going to be a higher payment because it's a more expensive home. But now you get the double whammy of the higher price and the higher interest rate, and that keeps sellers on the sidelines. So that's why we're seeing this huge cliff. I mean, that is a real cliff drop right there. I mean, that is scary. If you owned a stock and it looked like that, boy, what do you do?
I just went through that with one of our favorite equities. The electric car one.
Tesla.
Yeah, man. I bought. I bought 4 times on the way down and still missed by 30%. Had a nice week this week, but man, I was sweating it there for a couple of months or so.
Have you been seeing my videos on this one?
Yeah, but I bought. I think I was about 2 months ahead of you. I think I got in at first buy. It was at like 265, and then I bought again at 240, and then again at 220, and then again at 200. And where were they at when you started? Kind of looking. I know I saw your post about backing the truck up and loading up on them, but what was that like? What was that like 130 or something?
105 was my last one. So I started at 157, and I really, really waited patiently for this. I thought this situation that was going on right here was going to be a wick down, kind of a wick low situation, and that we were, just sort of sweeping the lows and going to take off from here. And so I started buying at 57, but I also knew that there was a lot going on with Twitter and Musk and everything.
Yeah.
And so
taking on the establishment.
Yeah. Taking on everybody. Right.
Like, come on, bro.
Pick your spots, Elon. So when this rejected here and we got this bearish engulfing, I was like, shit, but I was glad that I only put in, a little bit to begin with. You always dollar cost average into these things. Right.
Right.
But I expected us to get to 105. We actually got to 101 and change. But my last bid that got filled was the 105 bid. I had bids at 100, 95, 90, 85, all the way down to 60 because this earnings report, I didn't know it was going to happen, right?
Right.
Well, you got an absolute short squeeze, rocket job here. Just absolutely melted through this resistance. I mean, this should have been a huge inflection area for the stock to reject off of. It had nothing to do with that. It was just like, so we're headed up to the next one. I think you're going to see 200 here before long. But it's always hard to say, in these short squeezes, how long, price will last. But I think it's very clear that this idea that Tesla is somehow screwed or in trouble or whatever is just simply false. It's just not the case. They're absolutely murdering the car game. They're growing quickly. People love the vehicles. The vehicles are tremendous. I drive one. It's amazing. But what I'm most excited about, brother, on this one is the robots.
Yeah.
I mean, from an investor standpoint, scared as hell as a human being.
That's right.
But I am, as an investor, like, this is going to work. The robots are going to be amazing. They're going to do stuff. I mean, I don't know if you've heard him talk about what the robots do, but literally whatever, like, hey, can you clean the house? Can you put the dishes away? Will you pick up the backyard? Like, you can teach the robots to do anything that you need to do. And they're going to be like $20,000-$25,000.
I didn't catch any of that. No, I kind of clicked off the whole robot thing when he talked about the assassin drone with the 3 gram shape charge in it and facial recognition. I'm like, yeah, I've seen this movie like 7 times.
Yeah, I know, man. It's hopefully, we don't know what's going to happen. Hopefully it'll be good.
Yeah.
But I tell you this, at least for a certain period of time, it's going to be great. These robots are going to be able to do all kinds of things. It's really, really a big deal, and they're going to be bought commercially on a huge scale. So that's what I'm mostly excited about over the next 10 years for Tesla.
Sure.
But in the meantime, they're absolutely crushing the car game. So yeah, we started averaging it at 57, averaged all the way down to 105. And I haven't had any bids filled since 105. I've been trying to put bids under the market, and just there hasn't really been any pullbacks. And then of course earnings, kicked off, and you got the short squeeze. So we're up to 177. So yeah, that's a big one. The S&P, by the way, for people there's a lot of people who are still really bearish on stocks too. I can't believe how many people are telling me bear market rally. It's just a bear market rally. Like, okay, well, I don't see that. I mean, I agree with you. It could have been, we had a bearish horn here that we got out of. We closed above 3 days in a row this week. And then we had this downtrend line and we closed above the last 2 days of the week. So guys, like, the major resistance there has been cut up.
Yeah.
I mean,
we're over it. There's too much liquidity out there. There's still too much money, too much cash, too much, it's that we got through the pandemic and the inflation piece, and I think it's pulling into focus now. We did it, or at least the financial folks, Powell and
on the other side of it.
Yeah, they did it right. It wasn't fun, paying almost $7 a gallon for gas, and apparently that's not even correlated. But I'm not looking. I don't look forward to my utility bills like I used to, but because they're double. But it sounds like we're I think we're going to be just fine.
I mean, if you look at, I think Facebook's a great example. People see the layoffs and things like that, and they think it's bad. You understand from a business standpoint, layoffs are good. That means you're cutting fat. That means you're increasing profit margins. Facebook's a great example of this because they're building the metaverse, and it's a very, very expensive thing to do. Tens of billions of dollars, and they're losing tens of billions of dollars a quarter for a while, and that's why their stock got massacred. As soon as they started saying, "Okay, we're laying people off. We're doing we're going to slow this down. We're going to do this a little bit more quietly, a little bit more calmly, a little bit more conservatively, instead of just throwing money at this thing to try to get it launched." And look what happened. You get a massive gap down after earnings, but then they started laying people off and doing different things, and the stock goes higher. So when you see like negative news come out, a lot of times that is sort of the catalyst for, okay, we're at the bottom. Hey, they laid off a bunch of people. Now we can reload and expect, better things for earnings. When they report, when do they report again? February 1st. So we'll see how that looks. But right now, currently in a nice rising channel on Meta, which is one of my big holdings that I got into early on this one, brother. I got in the 200s, but been averaging down. And so the cost basis is in the green. And that's why you got to always DCA on these things. Okay, we've gone on a number of tangents here. I could talk about this crap all day.
Yeah, me too.
The main thing that everyone needs to know is this right here. You will not see the housing market crash with inventory levels at this level. It is not possible. It will not happen. We need 4 or 5 times as many homes for sale. And in order for that to happen, you're going to need prices to go up. We're just not going to see sellers come in at these levels, and they've proven that. So whatever anyone tells you, screenshot this, email me, forward this link to anyone who's bearish on San Diego real estate. Let them watch and see the numbers for themselves. Don't listen to Goldman Sachs. Don't listen to the news, and don't just read the headlines. That's my advice. Any advice for this market, Ryan, for buyers or sellers before we sign off?
Buyers, I think, and to your point about the stocks, the Tesla and the Meta, and I think you're going to see Amazon's going to crush earnings here at the end of next week, I believe. Turn around in hindsight, it paints a portrait of how great things were, right? Because if you're laying people off and you're still, making money and turning things around, it's really not the gloom and doom thing that the mainstream media wants to put out there. So I'll get off that soapbox. Buyers, if you're out there and you're panicked or you think you're going to wait until the interest rates are back in the low 3s or the 2s, you're likely going to end up costing yourself far more money in the long run than or in the short term than you will in the long run. Sellers, I'm in the same boat. My wife and I, we've got a home that's far too big for us. We got a number 2 going into college next spring, next summer, or next fall, and it's 3 of us in 4,000 square feet. The hell am I doing? And so I got to make a decision here probably this spring. I think and I'm not going to use anybody else as a guinea pig, but I think I'm going to list my place in April, and I think we're going to downsize or grab a place that's a little more fitting for us because just too much, too big, too much to take care of, too much to heat, too much to cool, and now that I've replaced everything big, the furnace, the pool gear, the water heater, everything, the AC, I might as well move on and start all over, replacing a bunch of shit in the house.
May as well.
Right. It's the old Marine Corps adage, let's make it better than it was when we got here and then move on and let somebody else have it, for crying out loud. So don't be afraid. potential sellers that are considering the market probably bought in 15, 16, 17, and they got to do something. Downsize, upsize. Don't be afraid. It's there's 49 minutes of examples why I think, or we think, or expert opinions that it's going to be a good spring and a good summer and probably a much better year than anybody thought 6 months ago.
100% agree. Very well said, my friend. Ryan Street, great to have you. Thank you so much for joining me.
Hey, really thanks for the opportunity, buddy. Thank you.
You're awesome, my man. All right, team. So, I've been telling you these things for some time. No secrets. No secrets. I just share with you everything I'm seeing myself. Occasionally we have a great guest on who brings their own information in as well. This inventory, it's not a thing that you can just brush off. If you're bearish, you can't look at this and go, oh yeah, but that doesn't matter. This is everything. This graph is everything. You want to understand what's going on with real estate. Literally, there's nothing else. So if you want to get a quote, a loan quote, a rate quote, a fee quote, we don't charge anything. Give me a shout. Call, text, email. I will be here when you need me. Have an amazing weekend.